Good afternoon. So go to statement of comprehensive income. When we talk about statement of comprehensive income, it's basically the sales of the business, the income made by the business. That is what it means. So the business would have been selling goods or services. So whatever you sell, what comes into the business is income. So we try to break them down. That's why we call it comprehensive income, because it's going to be part of our financial record. Remember we said a business needs to maintain its financial record to be able to manage its cash flow. Yes or no?
Yes.
So that's why we need to talk about statement of comprehensive income, which is about goods that are purchased, goods that are sold. The spending, the income and the expenditure of the business lies here. Scroll down, please. Yeah, thank you. So the purpose of a statement of comprehensive income. Businesses use the statement of comprehensive income to calculate the profit at the end of the financial year. So as soon as you sell, your aim of buying or your aim of purchasing is to be able to sell to make profit, yes or no? The aim of purchasing, the aim of starting the business is to make a profit. So in your statement of comprehensive income, you'll be able to understand how your profit is generated. So you're going to have your gross profit and the net profit. So how do we generate our gross profit? How do we generate our net profit? Get to know. So profit will be made through the comprehensive income. So at the end of the financial year, so the financial year is a 12-month trading period and can vary from calendar year to, for example. So what they are saying is, the financial year doesn't mean it should be from January to December. It could be from June to May. It will be from July to June. Do you get it? But it has to be 12 calendar months. That is the point. So it doesn't necessarily be January to December. Any question about that?
No.
Shall we move on? Okay. First, it calculates the gross profit. So how do you calculate your gross profit? So your gross profit is your sales minus your cost of sales. Your sales minus your cost of sales. So let's look at this side. Gross profit. This is the profit made before expenses or overheads are subtracted. We already know what overhead is, your office expenditures. So you calculate your gross profit before the profit for the year, which is the net profit. So here they said gross profit is revenue minus cost, which is what I just said now. I said sales minus cost of sales. So your sales, your revenue is the same as what? Sales. Minus your cost of sales. That gives you gross profit. Is gross profit clear?
Yes.
And they said then it calculates operating profit. This is the profit after expenses and is funded by. So as soon as you calculated your gross profit, remember and note that is not your final profit, because you have to incur expenditures. You have to pay bills. All these things are calculated after your gross profit is made. Your gross profit is basically the amount you made in the cost of purchasing and selling the product. And as soon as that is done, the amount it costs you to purchase the product, the amount you sold the product, that gives you your gross profit. It does not entail the amount you are spending in terms of overheads, your expenses, your wages, your salaries. All these are expenditures. Lighting, electric bills, stamps, insurance, all these are expenditures that has to be paid. So as soon as you have calculated your gross profit, the next thing you have to think is what? The operating profit, which is the same as the net profit. So let's look at what they said. They said operating profit is gross profit minus expenses. That's the next thing. Gross profit is sales or revenue minus cost of sales. Done. For operating profit, it is this minus this. Your gross profit minus expenses gives you operating profit.
So operating profit is the same as net profit.
The net profit will come as soon as you take away your taxes, because you have to pay taxes too.
Taxes is not. It's expenses too. So.
Yeah, but it's we don't seem to call it, it has to be after operating expenses, after operating profit. So scroll down, please. Do you have any questions about the ones I talked about?
No.
No, great, okay. It said retained and distributed profit. So some of the profit made by the business at the end of the year is used to pay taxes. See, as soon as your operating profit is known, you have to pay tax. So when you take away tax, then you get your net profit. So that's the final profit. Any question about that?
No.
It says sole traders and business partners may pay income tax, whereas limited companies may pay corporation tax. So taxes paid by a sole trader is called income tax, just like individual tax. Partnership also they pay income tax. But as soon as you become a public limited company or a private limited company, hello. As soon as you become a public limited company or a private limited company, you pay corporation tax. Do you get the difference here? Sole trader, that means one-man business, they pay income tax like individuals. We pay income tax. Partnership also they pay income tax because they are unlimited liability. So they pay income tax. But a limited liability company will pay corporation tax. I think that is clear. Is it clear, please?
Yes.
Now, they said the profit after tax can be distributed profit or retained profit. So, as soon as you pay your PBIT, they call it profit after tax. PBIT. Is it PAT or no? Profit before? No, this is before tax. But as soon as you pay your profit, as soon as you pay your taxes, the amount that is left, if you are taking back to the business, it is retained profits. If you have to share to shareholders, then you distribute it. Do you get the difference here?
Yes.
Look at what they said. They said the profit after tax can be distributed or retained. It is distributed when you have to think about sharing it to the shareholders. It is retained if you are putting it back into the business.
Well, Mr. For a sole trader, there's no such thing as distributed
profit. Yes, because all the profit belongs to the shareholder, to the owner of the business.
Yeah.
But for public limited companies, they have investors, they have shareholders that they have to share profits to in form of dividends. Do we get it? Any question about dividends here? That's the share of profit. Dividend is what? Share of profits to shareholders. Any questions about that? Shall we move on? Yes. Okay. Yeah, thank you. So, the statement of comprehensive income. So, the statement of comprehensive income shows the income and expenses of a business during the financial year. So, we call this statement of comprehensive income. It does not only require you to place or to post your income, also your expenses for the whole financial year. So, this is a typical format of a statement of comprehensive income. Look at it. We have our revenue, which is the same as sales. These are our cost of sales, which could be our carriage inward. Our cost of sales could be carriage inward. What is carriage inward? The amount we spend to bring the product into the premises. Do you understand what carriage inward is? Yeah. It is part of your cost of sales, yes or no? It is not expenses. We have carriage inward, we have carriage outward. Carriage outward will be calculated under the expenditure. Carriage inward will be calculated in the expenditure. Before you calculate in part of your sales, because you incurred it in the cost of bringing the product you are about to sell. Do you get what I'm saying here? No. For your cost of sales could be purchases. You less your stock, you less your closing stock. Let me write it down for you, please. For cost of sales, we have purchases add opening inventory, less add carriage, purchases, add opening inventory, add carriage, less closing stock or closing inventory. They are the same. This gives us our cost of sales. Do you know what I'm saying there? All these gives us our cost of sales. That is in accounting. But in business, we are using cost of sales alone. But the requirements or what the contents that brings about cost of sales are all this. Your purchase is what you have bought into the business. That's your purchase, what you're about to sell. Your opening inventory, those ones that you have available in your stock. Carriage, the amount you spend to bring this into the business. Closing stock, the value of what is left in the business. When you minus it from this, you get your cost of sales. So your cost of sales, revenue minus your cost of sales gives you your gross profit. Do we get it or not? These are the components of cost of sales. But in business, you might not be given all this. You might just be given the cost of sales. But you have to note how we make up our cost of sales.
Yes.
Are you with me?
Yes.
Great. So your cost of sales minus your sales gives you your gross profit. So look at here. We have our revenue to be this amount, our cost of sales to be this for 2016. So this minus this gives us our gross profit. Do you get it?